Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, stocks jumping this morning after a U.S. court struck down President Trump's tariffs, declaring them illegal. The ruling could eliminate new tariffs on China, Mexico, and Canada, as well as President Trump's Liberation Day so-called reciprocal tariffs. The Trump administration immediately said it would appeal the ruling, putting the fate of the tariffs in the hands of an appellate court and potentially the Supreme Court.
Plus, the other big focus for investors this morning, Nvidia. Shares jumping in pre-market trading after the company offered an upbeat sales forecast, easing investor concerns about a slowdown in China.
Today, however, the $50 billion China market is effectively closed to U.S. industry. China's AI moves on with or without U.S. chips.
The company expects revenue of about $45 billion in the second quarter fiscal year. And meanwhile, new export restrictions will cost Nvidia about $8 billion in Chinese revenue during the period, but the forecast still met analyst estimates.
And the latest read on the economy coming in better than expected, still showing an economic contraction of 0.2% for the first quarter. Second read on quarter one GDP coming in better than the initial report, but still shrinking amid weaker consumer spending and a surge in imports. A risk-on rally underway on Wall Street after a U.S. court blocked the majority of President Trump's tariffs and as investors cheered Nvidia's results. Taking a look here at stock futures, you've got that risk-on trade unfolding. Your S&P 500 up 0.7%, just 4% off from its all-time highs of the year. The tech-heavy NASDAQ taking on the majority of those gains with Nvidia there. It is up a little over 1.2%. But let's flip the board over to the bond market here. Taking a look at Treasury yields on the 10-year up just a touch. You can see the front end of the curve coming in just a bit. The longer end of the curve continuing to move to the upside, though the 30-year is still below that key 5% level. It'll be interesting to see how the stock-bond correlation unfolds today with this risk-on mood taking Wall Street.
President Trump's tariff blocked by a U.S. court, which declared them illegal and throws his tariff strategy into turmoil. The ruling could eliminate new tariffs on imports from China, Canada, Mexico, and other countries, but the Trump administration has said it will appeal the ruling. Here to break down what you need to know is Yahoo Finance legal correspondent Alexis Keenan. Alexis, this all started with the invocation of the International Emergency Economic Powers Act here.
Yeah.
Where do things stand now?
So this is a tremendous ruling by this court coming down late last night. And what the three-judge panel in Manhattan said at the International Trade Court is that the law that Trump relied on, that you just referenced there, the IEEPA, that's the International Economic Emergency Powers Act, it's a 1977 law, that it does not support the type of what the court called unbounded tariffs that come in President Trump's executive orders since he took office in January. They said that type of authority, that must come from Congress. Now, this law is meant to address unusual and extraordinary threats to national security. That is after the president would declare a national emergency. But the court here is saying, no, the type of emergencies that the Trump administration has put forward are not good enough to satisfy this law. And those specifically, if you remember, were trade deficits, the flow of illegal drugs, and the flow of illegal immigration. Now, in a response, the White House has said, made this kind of balance of power statement. That's what this case is about. The White House saying these deficits have created a national emergency that has decimated American communities, left our workers behind, and weakened our defense industrial base. Facts that the court did not dispute. It is not for unelected judges, they say, to decide how to properly address a national emergency. So the Trump administration there is saying that that is the job of the executive, and that's much of what this case was disputing here. Now, let's briefly take a look at the tariffs that are impacted. It's most of the tariffs that have been applied since January. So that 10% baseline tariff on all imports to the U.S., also the 25% tariff on all imports from Canada and Mexico, except for some steel and aluminum tariffs that aren't applying here. also those were under a pause as well. So in addition, the 30% tariff that was also pending against China, also on a pause there, as well as these reciprocal tariffs that build on top of those 10% baseline tariffs. The Trump administration has already immediately filed a notice of appeal. They have about 30 days to file if they want to do that. And where this case would go next is the U.S. Court of Appeals for the Federal Circuit. They're the ones who would take up this matter from here.
Let's talk about that then, Alexis, because two things stick out to me. Reading through the document this morning, they basically give President Trump the playbook here. They talk about Section 122 potentially being a better fit than IEEPA. So could he utilize that to get around any pushback from those appellate courts, from the Supreme Court on his tariffs?
That's what we would expect. Now, in the oral arguments for this case, there were a lot of questions from the judicial panel saying, well, where do we draw the line exactly? How far does IEEPA extend? Give us some parameters, lawyers who are arguing on behalf of your clients. Tell us where to go. Now, in this decision, that doesn't exist, right? There's not a hard line. It's more of the judges saying, well, whatever Trump's administration did to justify, there's not a tight enough nexus between addressing the national security and the tariffs, that they are not a perfect fit. So yes, we would expect to see those types of arguments come through. Another really interesting aspect that I saw in a Politico story this morning is that the idea that the government may have to pay back tariffs to countries where tariffs have already been assessed, so that could come at a big expense as well.
Always so much to cover. I also thought it was interesting, the judges behind this too, very mixed when it comes to political background, which is interesting given.
Yes, but yet a unanimous
have
decision
unfolded.
here.
Absolutely, really important context. Alexis, thank you so much for joining us this morning. Well, let's talk about that risk-on rally underway on Wall Street as investors cheer a court's ruling to block Trump's tariffs. And as Nvidia offers an upbeat forecast, sending shares higher. The big question, can the gains last? Joining us now, we've got Mark Hackett. He is Nationwide's chief market strategist. Mark, it's great to speak with you this morning. Talk to me about what's making you more bullish this morning, the wrap-up of these tariffs potentially off the back of this ruling, or Nvidia earnings?
Well, I think both of them are fairly reactive. And, we've seen just this week the intense scrutiny that investors are placing on tariff headlines. We've seen this move back and forth quite a bit over the past 2 months. So obviously that's the bigger macro story if it ends up being what it is. But we also have to keep in mind, there's been a lot of moving parts on the story. Every time we think there's a definitive conclusion, some other news item comes out and changes the story. So if this ends up being what the ruling is, that will be very much of a tailwind for markets. But again, I'm a little skeptical, and I think most of us should be until we see the whites of the eyes. So we're telling investors, you remain informed, but don't be reactive to these types of news. The Nvidia news, I think, is just a reminder of just how much the Mag 7 story remains in our minds. The fact that we talk about tariffs and Nvidia, yet the Fed minutes yesterday had almost no reaction, I think is a sign of just how much the market focus has shifted.
How much of the upside that you were mentioning a moment ago on the tariff front that the markets could potentially continue to see as a result of this, how much of that do you think we could still potentially see come to fruition here, especially knowing we're just about 120 points off from that 6,000 level right now?
I think we're probably close to running out of steam with tariff tailwinds. Remember, the math that got us to the almost 20% drawdown early in the year was no more precise than the math that we've seen since, causing a rally back almost to where we started the year. So I think we are going to have to start transitioning to a fundamental catalyst. The technical catalyst has been great. It's been nice to see. But at some point, we're sitting at a fairly elevated valuation for the S&P 500, and estimate revisions have been slightly negative, resilient but negative. So I think we're going to start needing to see those revisions stabilize and start moving higher before we can see a next step higher in the bull market.
And what gives you confidence in the ability for that to happen going forward? What do you think is the potential catalyst for that?
I think the number one issue is the lack of confidence in the consumer. So the consumer spending has been quite strong. We saw credit card data this morning that was strong. Really, the retail sales numbers have been resilient. So there's been this strange lack of correlation between what consumers are saying with the soft data, obviously, and what they're doing with the hard data. So if the consumer continues to spend, and some of these worst case scenarios, which I think likely some of the tariff-based worst case scenarios were cleared up last night, that does set the table for an acceleration in consumer spending and corporate earnings. That I think is going to be necessary for the next move higher, probably in the second half of the year.
Mark, that's continuously perplexing to me because as I think about more people tapping credit card or swiping credit card in order to spend, then that would also suggest that maybe they're doing that from a point of necessity just to perhaps be able to give themselves a little bit of a bridge to pay things off over time. You talk about people, or at least we've talked about people paying off for their burrito in multiple payments on Klarna. So all of these things considered, what is the true health of the consumer through your assessment and through the lens of corporate America as they're trying to understand where consumers do actually maintain some semblance of strength on the higher income scale versus the mid to lower income groups that are clearly seeing some and feeling some pressure?
Yeah, I think you nailed it. The dichotomy between higher income consumers and lower income consumers is wide. For example, we're seeing credit card delinquencies at very elevated levels at this point, which you would say would be a bad sign for the consumer. But from a human interest perspective, that's absolutely the case. But unfortunately, that's not the way the math works for GDP. Higher end consumers and the higher end of the middle income consumers account for the overwhelming majority of spending. So if that group's spending, it's going to be a tailwind for the economy. Again, that doesn't necessarily mean from a human interest perspective that, for example, inflation and some of the uncertainties that we're seeing is a struggle for the average consumer. That doesn't necessarily work that way with the math.
Mark, good to have you here with us this morning. Mark Hackett of Nationwide. We appreciate the time.
Thank you.
Nvidia sparking a chip rally after topping first quarter expectations with revenue soaring 69%. The company also warning of an $8 billion revenue hit in the second quarter due to China export rules. CEO Jensen Huang says that the curbs weaken America's position.
China is one of the world's largest AI markets and a springboard to global success. With half of the world's AI researchers based there, the platform that wins China is positioned to lead globally. Today, however, the $50 billion China market is effectively closed to U.S. industry. China's AI moves on with or without U.S. chips.
Joining us now, we've got Antoine Chkabin, who is the New Street Research Technology Infrastructure Analyst. Just want to start with your biggest takeaways from the results, especially considering what we just heard in the soundbite there from Jensen Huang.
Yes. Hey, Brad. Hey, Madison. Thanks for having me. So, yeah, of course, there's this $8 billion headwind, in the second quarter. And despite that, you have Nvidia guiding data center revenues up modestly. So that's, a very significant guide up if you account for the headwind. And I think the key takeaway here is that there's a surge in inference demand. All these reasoning models that have been introduced over the course of the year, O3, O4, DeepSeek, that are capable of generating a lot of tokens to improve upon their answers. That's driving a lot of demand for compute, and that's, I think, is the key takeaway from these earnings. Of course, that translates into a lot of demand for the latest generation, Blackwell. I think there were a lot of concerns around the potentially production challenges there. I was in Asia last week. I got the opportunity to talk about the supply chain. And indeed, Nvidia faced a lot of challenges. It's a very challenging product to ramp. And now we have visibility into 1,000 of these racks being installed at their hyperscale customers every week. So that's kind of dismissing any concern around inventories building up at OEMs for Blackwell. So I would say those are the key takeaways from the print yesterday.
And I know you mentioned in your note that you sent over to us that you are still buyers of any weakness. What is your long-term bull case for Nvidia, especially given some of the concerns that we'll get to regarding some competition with China specifically?
Yes, so on the demand side of things, our view is that the token is the new transistor. That's our motto. So when you're able to innovate at a pace that allows you to lower the cost per token, that drives tremendous demand. And, to go back to the reasoning models that I was talking about earlier, there's an opportunity to solve humanity's greatest challenges by putting AI at work, in data centers, in huge data centers that are going to comprise millions of XPUs in the next couple of years, putting those data centers at work to try and solve quantum physics, to try and help companies design products, to try and help governments, optimize their budgets. And I think that's our long-term view for AI in general. Now, with regards to your question on competitive dynamics, so there's the China problem. There's more generally, the debate around whether hyperscalers are going to ramp in-house chips. I would say, Nvidia has a head start, clearly, because they have a very strong ecosystem. They have a very large installed base. People know how to use their GPUs. You have universities who are teaching their students with Nvidia GPUs and who have been doing so for 10 years, like in computer science departments. And so that's very hard, to break that kind of ecosystem strength. And then with regards to China, so yes, as Jensen mentioned yesterday, there is a huge market there. And if Nvidia doesn't address it, if the US platforms don't address it, well, China is, of course, ramping. We've heard about Huawei's Ascend chip, who is reportedly becoming competitive, excluding these ecosystem barriers, who is becoming, competitive on paper progressively. I mean, there's still a gap, but they're trying to catch up, and if you don't, maintain Nvidia's leadership thanks to its ecosystem, and you allow, that new ecosystem to emerge, well, yes, that's a lost opportunity for the US. So that's, Jensen's message yesterday as well.
Antoine, there's also this transition from Hopper to Blackwell, and really contributing. Blackwell did nearly 70% of data center compute revenue in the quarter. Given that transition from Hopper nearly complete here, I want to play a clip on just what they had to say about Hopper on the call.
The H20 export ban ended our Hopper data center business in China. We cannot reduce Hopper further to comply. As a result, we are taking a multi-billion-dollar write-off on inventory that cannot be sold or repurposed. We are exploring limited ways to compete, but Hopper is no longer an option.
Okay, and so they also said that they sold H20 with the approval of the previous administration. H20 been in the market for over a year, doesn't have a market outside of China. Is there a larger headwind that they should be considering, or that investors still need to think through with regard to H20, given the geopolitical concerns that every company has had to acknowledge?
I don't think so, because if revenues would have been 8 billion higher in the second quarter if they had H20. So now China is almost out of Nvidia's numbers. So now, if anything, there's a potential tailwind. If Nvidia is able to again work around the new export controls and introduce a new Blackwell SKU that can ship to China again, and there's been, this game over the last few years. It's not the first time, that a product is banned. You had like A800 and you had H20. And so now anyway, Hopper is coming to an end. As you mentioned, 70% of data center compute, that's like 24 billion Blackwell says in the quarter. So Hopper and everything else is now less than 10 billion. In Nvidia's numbers. So I would say now we're transitioning to Blackwell. Now China, we don't know exactly whether Nvidia is going to be able to address that market again. There's been some news flow, in recent days around the fact that they're working on something. Jensen confirmed that yesterday. Yeah. He said he had nothing to announce. But yes, there's clearly an opportunity if Nvidia is able to work around the new controls.
30 seconds left. We know that there's a Trump put in the bond market. Is there a Trump put in Nvidia's stock price?
I don't think so. I think the stock price is back to 2024 levels, and I mean we're 1 year later, we're still at 2024 levels. Nvidia can grow, revenues 15-20% growth beyond 2025. I think there's a lot of upside. If you put like a 35 times multiple on 2026 or 2027 earnings, you still have like a target price in the $200 region. So there's a lot of upside.
Antoine, thank you so much. And you can find all of those data points Antoine just mentioned, plus NVIDIA's full earnings call on the Yahoo Finance website. Be sure to check that out. We're going to have all your markets action ahead, so stick around. You're watching Morning Brief.
Now time for some of today's trending tickers. We are watching Tesla, HP, and Foot Locker. First up, Tesla. Elon Musk gearing up to leave Doge and return to his businesses. Musk signaled on Wednesday that his time leading Doge was at an end. In a post on X, the social platform he owns, the world's richest person thanked President Donald Trump for the opportunity to reduce, quote, wasteful spending, adding that Doge's mission will only strengthen over time. Shares of Tesla are pushing higher here today by about 2.5%. A lot of people will know that as a special government employee, he is only allowed to actually work a federal job for 130 days each year, which essentially would come to an end this week.
I thought it was really interesting to see sort of the capitulation from Elon Musk after the market reacted as they did. And this is why I personally love what we get to do every day with monitoring markets, because it has a huge impact. It can impact who is, feeding information to the president of the United States. So it's interesting to see that the reaction in Tesla perhaps was something that was on his mind when he did pull back from his role in the government.
It better be on his mind. The shares were sinking. They were losing any type of sentiment that ultimately was annexed to how successful or unsuccessful the White House was at communicating their strategy, which controversial at best. And Elon Musk putting his mug next to that essentially also impacts all of the businesses that you run as well, for better or for worse, as he was trying to get government contracts with some of those businesses. And then for Tesla, which is far more consumer facing, you rely on still having the favorability of purchasers. Oh yeah, at a time where in the consumer confidence readings, there were more pushbacks, at least in the interim period of time, of people putting off some of those big ticket purchases, including an electric vehicle.
And you saw that in the global sales data as well. Absolutely. All right, next up, let's talk about HP sinking this morning. The company's profit outlook fell short of estimates, and it cut the annual earnings forecast as well, pointing toward a weaker economy and continuing costs from U.S. tariffs on goods from China. What's fascinating about a name like this is that this morning we have the news of that ruling from a U.S. court calling on the president's tariffs to be repealed, and potentially, as Alexis Keating was telling us, that some countries would even have to get paid back for the tariffs that they have already been charged. Having said that, for HP, the problem is that profit outlook getting cut. Whether or not the tariffs stay, that is something that is clearly negatively impacting the stock price, down over 11%.
Yeah, spot on. Second quarter net revenue, it was actually up 3.3% from the prior year period here. And then additionally, thinking through what the company was saying, and they had to acknowledge around some of the increased macroeconomic uncertainty, they've adjusted their outlook to reflect moderated demand and the net impact of trade-related costs, to your point, and they're executing targeted mitigation strategies as well, assuming current conditions remain. They expect to fully offset those costs by the fourth quarter of their fiscal year. Shares, though, down by about 11-12%. Finally here, let's go where the feet go. Foot Locker, the company out with earnings and missing sales estimates. The miss comes as the parent company prepares to be acquired by retail giant Dick's Sporting Goods for $2.4 billion. Shares of Foot Locker flat just barely to the upside. One of the things that is always interesting for me to track is where they are on their store footprint. And one of the things that I was circling within my own notes here is that they actually just continue to close more stores than they are opening. They're also going through this process of remodeling and bringing more stores essentially up to snuff with their own expectations. And so the exact numbers on that, in the regions that it impacts as well. Company opened 9 new stores, closed 56 stores, including stores operated in South Korea, Denmark, Norway, Sweden, Greece, Romania. You will get less of those exclusive drops. And then additionally here, remodeled or relocated 11 stores, refreshed 69 stores here. And it'll be interesting to see where they have more weight to potentially throw around once the deal is consummated with Dick's Sporting Goods, with major brands like Nike, like Adidas, to make sure that they get priority selection in some of that inventory going to retail partners.
I think one of the things that's really interesting here, too, from an economy perspective, is something that Sucharita Kodali had called out to both of us last week, the idea that you see evidence within this print of wholesalers getting access to more inventory, a little bit of that pull forward dynamic happening here as they anticipated these tariffs, which again, as we have headlines coming in today, unclear what those tariffs are going to look like more long term, but we still have that impacting a print like this where you do have a little bit of that pull forward dynamic going on, and then the questions about what that's going to look like for their sales going forward if they've already missed on estimates this quarter.
I was part of the numbers in this quarter. I'll admit it. I saw some flu game Jordans at Foot Locker and Herald Square. I said, you know what? Take the money.
He's a consumer too, you know? We're all people. All right, well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page.
Then you're taking a look at the opening bell at the New York Stock Exchange. First Eagle Investments, fly, Eagle, fly. All right, they get the song, why not? And the NASDAQ celebrating 25 years of what looks like ISE, we're gonna go with here on the day. The font needs to be blown up just a little bit. That's my only criticism. However, great bell ringers on both sides, and they got some funfetti for it on this Friday's Eve. Take a look at the Dow Jones Industrial Average. It's up right now by about 0.2%. The NASDAQ Composite, you're seeing that open up higher by about 1.4%. We'll dive into what's driving that here. Nvidia. S&P 500, you're also seeing that higher by about 0.8%. All of the major averages also seeing a little bit of a boost coming off of the Federal Trade Court ruling that the tariffs that were put in place and citing some of the international emergency, the Powers Act that President Trump tried to invoke, they said not yet. And ultimately that and the ruling there, which is set to be appealed, that ultimately is moving some of the major averages higher here and some of the broader market sentiment, factoring that in on the day. Let's take a look at technology. XLK, you're seeing that jump by about 1.3% here on the day. And then additionally, pulling up the caboose, consumer staples right now, that's lower by about 0.3%. One of the safety trades, a safe haven asset right there, or trade pocket of the market, however you want to call it down today. Nvidia, after earnings, you're seeing that rip to the upside by about 5.5%. Want to put a longer term chart on this just so you can see exactly how we've been moving year to date, and we are now back into positive territory solidly year to date by about 5.9%. We'll continue to watch that very closely here. Of course, there was a lot of room that we had to ultimately, and ground that we had to make up, but post earnings, we've seen exactly that happen here, and I'm going to take a look just quickly at a one-year chart. There we go, 1 year past 52 weeks, and you're seeing us not quite hit up on that top, but we are getting close to those levels here for Nvidia. And then additionally, taking a look at some of the other Mag 7s on the day, they're all higher across the board. I'll put this on an equal view for the NASDAQ 100, far more gainers than laggards. However, bringing up the caboose, the brand of the green siren, Starbucks, you're seeing that pull back just a little bit. It's down by about 1.1%. Somebody get it some coffee. Maybe it'll know how to race to the upside. And the Dow Jones Industrial Average, Dow 30 components, we've got those mixed here on the day, but more green, it looks like, than red. CRM, Salesforce, post earnings. We're going to talk about that in a hot second. That is pulling up the caboose, down by about 6%. Maddie?
Brad, thank you so much for getting us that opening bell. Let's get to three market movers you need to watch for your trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Maddie. We got to start with Nvidia because that breakout, that is a story of the day, and we're going to cover that in a second. But I also got to give you an update on the U.S. rates picture. We have another big auction today. Then we can settle down for a couple weeks. And finally, we're going to track all of the stock breakouts that are happening. Well, some of them, because there are too many to mention here. But let's get to the Wi-Fi Interactive. I'm going to start in a place that I usually don't start here. I usually go to the indices, but I just want to show you what's happening with some of these breakouts here. We got the chip sector, we got tech, that is all leading up. This is a one-year chart, and let me just dial this down to a year to date. And hard to see here, but we've been consolidating, and this, semiconductors still have not broken to the upside here. But what has is the Mag 7 ETF, and that is on the back of that Nvidia breakout yesterday, and we're seeing that continuation today. Over $200 billion in market cap has been added to Nvidia, and we're looking at a 3-month high in that stock. Not going to show you that again just because Brad was doing an excellent job of showing you the year to date and 1 year, but suffice to say this is leading the Mag 7 higher here, and we're also seeing some leadership in some downtrodden sectors, at least over the last few days. KWEB, that is a Chinese tech sector ETF, that has not done very well recently. You can see it's kind of flagging here, but guess what? In the longer term chart, that is considered a bull flag. So we need to see a little bit of more bullish price action here, but one day is a start to that. Let's get to the U.S. rate picture, because I've been harping on the 30-year, and I'm just going to show you real briefly here how the 30-year is down, still down below 5%. There it is, 4.96%. I'll give you the year-to-date. Here's that spike that caused some ripple waves around the world, including in U.S. equities. That was kind of a defect that had to be cured, and now that we are down below 5%, we're seeing some bullish price action there. U.S. dollar index has moved to the downside. It was quiet early on, but we're seeing it hover near lows here. It'd be interesting to see if it breaks lower. That could be an indication of risk off. A lot of times we've been conditioned over the last several decades that a lower dollar is risk on, but if the whole world is selling dollars, it could be risk off. So it's very contextual right now, and we don't want to jump to any conclusions. But moving on, I'm going to show those breakouts that I was promising you here. And here is my heat map. And we're seeing a number of groups of stocks. We're talking about Nvidia a lot, but let's talk about Broadcom, because that is nearing a record high. And I'll show you the one-year chart. And there we are. We had a nice little bowl right there. Might have a cup and handle, so we might need to have the handle part, and that could take a little bit more time. But Broadcom looking like it wants to break to the upside here. We're also seeing Ralph Lauren, completely unrelated industry. And this is what I like about this particular setup here in the bull market that we have, is that we're seeing a broad base of industries and sectors all participating. There's Ralph Lauren. Looks kind of like Broadcom. Totally different stock chart, though, or totally different company, I should say. Very similar stock chart. Not going to go through my entire list, but I will note GE, Johnson Controls, and also Axon. So we've got a lot of capital goods sectors just racing to new highs. This is also a one-year chart, and you can see GE has just been hitting record highs very recently. That stock has been on a tear after their very substantial reorg and consolidation process. That just has been an incredible story here. I do want to also note that the S&P 500, this is coming from Ryan Dietrich, the S&P 500 is up 5% in May. He went back all the way to 1950. Every single time that S&P 500 has been up 5% or more in May, guess what? 1 year later, it has been positive 100% of the time with an average gain of 20%. So there are some bearish warning flags on the horizon. We could see rates become a problem again, but for the most part, the price action in the indices and in the internals in the market, under the hood, it's all flashing bullish signs right now.
Jared, thank you so much. Appreciate it. Let's check in on shares of Salesforce at the market open here, down about 6% as the company raised its annual sales forecast, suggesting that its AI agent product is on a path to contribute significant revenue. The street clearly not believing that this morning. Yahoo Finance executive editor Brian Sozzi sat down with Salesforce CEO Mark Benioff to break it down.
Salesforce out with better than expected earnings, also raising its outlook. Joining me now, of course, no stranger to Yahoo Finance, that is, of course, Mark Benioff, co-founder and CEO of Salesforce. Mark, always good to see you. I can't think of many companies out here raising guidance in this environment of slowing economic growth and tariffs. Like, what gives you the confidence to do that?
Brian, everything went well for us this quarter. We had bookings go well, revenue went well, and currency went well, and we're raising our guidance by $400 million.
Are more...
So, well, Brian, listen to this.
Yeah.
We're going to do more than $41.3 billion is our guidance for Salesforce for the year. So it's pretty incredible what's happening here.
Now, you and I have talked about this in the past, but are more folks paying for Agentforce?
More than $100 million in Agentforce ARR now happening, but more than $1 billion in Agentforce and Data Cloud ARR. Pretty awesome.
Mark, talk to us about...
So just so that means we have more than 8,000 total Agentforce customers. More than 4,000 of them are paying, Brian.
So you're not seeing any slowdown in AI. Some concerns off that Nvidia earnings miss. Shocker to me. I mean, are you seeing any of that over at Salesforce?
Well, we're just seeing some incredible results from customers. I have to tell you about this great story. Falabella, which is this amazing, it's the Nordstroms of Latin America. Are you familiar with them? We did this Agentforce trial in their Colombia business. It's gone so well. We did it through WhatsApp. We're now deploying through the whole region, all of Latin America.
Mark, of course, I'm following the really big $8.8 billion, $8 billion on Informatica. This is one thing that I heard from one of the folks that I talked to, that investors have gotten used to the margin expansion story that you have driven at Salesforce over the past 2 years. Is this Mark Benioff back to making these big deals and then going to give away that margin that you fought hard to reclaim?
Well, this is accretive. Our margins are intact. We continuing our buybacks. We're continuing our dividend. And, look, we're going to do more than 14.5 billion in positive cash flow this year. So we have enough to get to every hungry mouth, which is, you just identified a few of them.
But are you going to go back on making these big deals?
Well, you can see how we have a whole new disciplined approach to acquisitions, Brian. And this deal specifically, we walked away from it a year ago because the numbers were not exactly right. And then we came back to it because the numbers were right now. And this is just a great transaction for our company. Look, I've been working with Informatica since 2006. It's critical for every single one of our customers that they get their data together. When they're moving into this AI age, Informatica is key to making that happen. It's going to give them the harmonization. It really protects the data lineage. It gives them the ability to do master data management. It's everything that you want in this modern era. And this is a great transaction. We've had so many customers call us and talk about how they're so excited that we've acquired this company. We're bringing this into our data cloud strategy. I mean, I expect that probably next year we're going to do more than $10 billion in data type products. Like, when we look at something like Agentforce, when we look at data cloud, when we look at Tableau, it's a huge part of our business now, Brian.
Lastly, Mark, Informatica is known in some circles as the Switzerland of data, meaning they're a great independent third party. They do business with Oracle, which is a company, of course, you know very well, AWS. Talk to investors to the extent you could about any concerns about losing some deals because they are, I guess, no longer potentially that Switzerland of data.
Well, we, of course, buy companies that deeply integrate with all of these companies all the time. And so, like a product like Tableau, you could say the same thing, and it's been a great success for us.
All right, we'll leave it there. Mark Benioff, always nice to see you, sir. Congratulations.
Brian, it's
on
great
this deal.
to see you.
I'll talk to you soon.
Look forward.
You can catch the full interview with Salesforce CEO Mark Benioff on the Yahoo Finance app, webpage, or streaming platform of your choice. Coming up, C3 AI jumping after reporting fourth quarter results. CEO Tom Siebel joins us next with more on the state of the business. You're watching Morning Brief.
C3 AI shares surging after topping fourth quarter expectations with revenue up 26% from a year prior. The AI software company also renewing and expanding its joint venture with energy technology company Baker Hughes to continue to develop AI solutions for the oil, gas, and chemical industries. Joining us now, Tom Siebel, C3 AI's founder and CEO. Tom, great to speak with you. Thank you so much for joining us. I want to start on that partnership because this is something that I have been asking you about for years because investors wanted to know if that partnership was going to continue. What went into those conversations and how did you get that deal done?
We've had an important strategic alliance in place with Baker Hughes since 2019. We've extended, I think, 4 times until now. So, I mean, it's been extended. And now we extended it for another 3 years, both in term and scope. So, I mean, it was a natural thing. I mean, it's a great partnership. We've closed, I think, over $500 million in revenue together. We've expanded into, Shell, ExxonMobil, LyondellBasell, Flint Hills Research, ENI, Petronas, Qatar Gas. So it's hugely successful. And I think that the speculation that somehow this wasn't going to be extended was candidly kind of silly.
Tom, good to hear that you're doing better and glad to hear that you're back out there traveling, and sounds like you've got an action-packed schedule, both speaking with some of the leaders in Washington, D.C., as well as just trying to get a sense of the pulse of the businesses that you work with closely. Outside of Baker Hughes, what are you hearing from some of the decision makers for big deals in the perhaps scrutiny for spends that they're facing right now within their corporations?
Federal government business is huge as they embrace commercial off-the-shelf solutions for enterprise AI, and be it FDA, be it Health and Human Services, Defense, Intel. I think we just announced this morning another expansion of our Air Force relationship. I think it's almost now approaching $500 million in business just for that contract. State and local government business is huge. Manufacturing, supply chain, banking, life sciences. Enterprise AI is a very rapidly growing market, and this is being reflected in the increasing growth rates for C3 AI. 2 years ago, it grew 6%. Last year, it grew 16%. This year, top line growth was 25%. That would make it, I think, one of the 5 fastest growing companies in the public software universe.
Well, Tom, the stock is still down about 15% year to date, but I wonder if we can talk a little bit about some of the headwinds that are facing broader AI giants right now, especially when it comes to export curbs, which obviously came up on Nvidia's earnings call. What are you seeing in terms of how any export controls might be impacting demand in the sector?
Well, first of all, our situation is a little bit different than Nvidia because we haven't done business in China ever. And we've made it a strict rule not to do business in China. We don't do business in Russia. So we just kind of don't do business in bad places. So export controls have had, to date, no impact on our business.
I understand that, Tom, but I'm curious about, Jensen Huang said it himself, it's leaving $50 billion on the table. Do you see a world where we start to see the AI market in China heating up and then companies like yours can't take advantage of that potential revenue stream because of export controls?
No, we made a decision independent of the United States government to not do business in China. We made that decision in 2014. We knew this story would not end well, and so we feel very comfortable not providing our technology to the People's Republic of China.
And so making the decision not to do business in China, but we know that the administration has also talked about tariffing cloud computing and even IT services, which is something that it sounds like would impact some of the applications that you are able to power through other partners around the world. What are you hearing from the elected officials in your talks with them, and how are you also going to bat for C3 AI that investors should know about so that you're not seeing any type of tariff on your own applications or services?
Well, I'm in Washington, D.C. today, as you know, talking with the United States government in many aspects, but there's been no discussion that we've encountered that it will affect our ability to provide our technology to our customers, be it in the Middle East, be it in Europe or South America. So we've seen no discussion that affects our ability to sell. I think it does affect chip manufacturers. It does affect Nvidia. It does affect others, but I've heard nothing that will have any effect on us.
Would love to be a fly on the wall in some of those meetings. Tom, thanks for taking the time here today.
Thank you.
Coming up, Best Buy is falling after reporting mixed earnings. We'll dive into the results after the break. Best Buy shares falling after reporting mixed results for the first quarter and cutting guidance over the Trump administration's tariff policies. Here with the breakdown, we've got senior reporter Brooke DePalma. Brooke, what do we know from these results?
Good morning to you both. Certainly investors really focusing in on Best Buy cutting guidance here across the board, now taking into account the impact of those tariffs. If you take a closer look at the numbers, revenue now expected for the full fiscal 2025 year to come in between $41.1 billion to $41.9 billion. That's down from their previously projected range. Adjusted earnings per share also expected to come in lower between the range of $6.15 to $6.30. Now, same-store sales also expected to come in lower for the year, between down 1% to up 1% for the year. That's down from the previous range of flat to up 2%. Now, overall for the quarter, it did come in mixed. We did see a beat on adjusted earnings per share, but the company did miss on both revenue and same-store sales growth. Now, CEO Corey Berry did tell reporters this morning that shoppers are really looking for value here when it comes to items, especially around those televisions. But key point here, they're willing to spend on new technology like computers and tablets. And moving into the second quarter, consumers still showcasing that same exact behavior, really deal seeking here.
I mean, you think about some of the responses that we had seen in consumer confidence as well within, I think it was the month of March into April, how they were pushing back on some of those major electronics appliance purchases. We only saw a rebound because some of the most severe reactions to the tariff policy had been abated by then. So how is the CEO, how is the C-suite of this company reading through that?
Yeah, well, certainly what we heard this morning, especially after that court ruling here, was the CEO, Corey Barry. She told reporters that this is a rapidly evolving environment that they're just responding to. And over the past 3 months, they've taken major actions. But in terms of specifically what consumers are concerned about, it's prices here. And what CEO Corey Barry did tell us on a call this morning was that this is not a static situation or a static conversation around prices. She went on to say, quote, "We have already made the pricing tweaks that we would expect up to this point. And we don't see a runway in front of us, but if everything stayed consistent right now, where there's more massively increases in front of us, well, that could change. But for right now, we feel like those prices have been passed on." She said that those price hikes were taken in mid-May. She also went on to say, talk about inventory. Many consumers really concerned here about will they have what they want back to school. And in terms of the holiday season, she said they're very well situated right now. And over the last 3 months, Best Buy has been very busy. They lowered their exposure to products, cost of goods from China from roughly 50% down to 30%. Of course, they did things like diversify their supply chain, work with investors, adjust their product assortment here. And so they feel like they're well situated moving into the back half of the year, but customers, they need to get spending again, and it's very uncertain.
And they also did acknowledge that they are going to potentially have to change things after that federal court ruling as well. Brooke, thank you so much. Coming up here, we've got Catalyst dedicated to your personal finance needs as well after Catalyst, so stick around for that as well.